As the first video of 2026, I thought it would be nice to reflect on past year's financial market. And for this video, I want to talk about the 2025 market crash. Why understanding US tariff actually matters not just to the investors, but for us as well. On April 2nd, 2025, when President Trump announced a new round of tariff policies, the US stock market dropped sharply. In just a few days, major indices like the S&P 500 and Nasdaq fall close to 10%. It is considered as the 2025 market dip or the 2025 market crash. At first glance, it may just look like another market shock, but when I looked deeper, I realized this wasn't just about the stock market. It was about prices, jobs, company decisions, and even where the future technologies will be built. A little background on the US economy and Trump policies. President Trump was inaugurated in January 2025 for his second term. Sometimes it feels like he's been around forever, probably because of how dominant his media presence is. His policies revolves around the idea of American first, prioritizing domestic production, domestic jobs, and domestic growth. At first, the US stock market reacted positively, but things changed when the administration began rolling out aggressive trade policies. It started with tariffs on Mexico and Canada, and then on April 2nd, the US announced reciprocal tariffs against more than 180 countries. So what is tariff really? A tariff is simply a tax on imported goods, and the reason government use tariff is very simple: to make foreign products more expensive so local products look more attractive. Tariffs are seen as one of the most effective ways to influence global trade and limit international trade with another country. But here's the key point: when you raise tariffs, someone has to pay. Companies, consumers, or both. And that uncertainty is why market reacted so strongly. The stock market is often like a mood ring for the economy. When investors saw the tariff announcement, they worry about one thing above all: inflation. Think about it from the consumer's perspective. If a product becomes more expensive, not because it's better, not because it has new features, but rather because of taxes, how willing are you to pay more? Probably not. So investors start to worry that consumers are likely to spend less, companies are more likely to earn less profit because of it, and the recession is likely to follow. That's why valuation drops so quickly. But here's where things get interesting. After the April announcement, the US began negotiating with major trading partners. Over time, the tariff rates were adjusted and reduced for many countries, and the impact turned out to be very uneven. Countries that trade heavily with the US, countries like Taiwan, Japan, and South Korea, felt the impact much more. However, countries who trade depend more on China or regional markets felt relatively less pressure. Large economic blocs like the European Union had more bargaining power because they could redirect trade elsewhere. So tariffs weren't just an economic tool, they're also a negotiation strategy. Looking back from the escalation on April 2nd to later easing of tariffs, we can see three clear goals behind the policy. First, to increase tax revenue from imports and improve government finances. Second, to reset trade relationship, making it clear that the US set the term. Thirdly, and most importantly, to attract foreign investment and bring production back to the US. And this part actually worked. SoftBank from Japan pledged about $500 billion to support US AI infrastructure. TSMC from Taiwan announced roughly $65 billion in total investment to expand semiconductor factories in the US, and Samsung and SK Hynix from South Korea committed tens of billions of dollars to semiconductor and battery manufacturing in the US. If these plans continue, 2026 could see a real increase in US domestic economic activity. The second big lesson from this period is about inflation. Investors initially feared tariffs would cause prices to surge, but the data tells a more nuanced story. Studies show average prices rose about 3% after a tariff announcement. Interestingly, companies absorbed roughly 2/3 of the increased cost, and consumers paid about 1/3. Not all tariff costs were passed on to consumers. And at the same time, the Federal Reserve cut interest rate 3 times in 2025, lowering borrowing costs for companies. This may or may not explain why Trump has been so focused on influencing the Fed leadership, wanting to change a Fed chair so badly. Lower rates soften the pain of higher tariffs. The final and most important takeaway is that it isn't just about the tariffs. It's about how the world is reorganizing. Are likely to move toward a future where the AI and tech supply chain splits into 2 major ecosystems, one centered around the US and one centered around China. Companies, countries, or even individuals may eventually will be picking which system they are more aligned with. Currently, as of date today, the leadership in the AI system will be the ChatGPT and Gemini in the US and DeepSeek in China. Technology isn't just about innovations anymore, it's also about infrastructure. And tariffs are one of the tools that help shape where that infrastructure gets built. And thank you so much for watching this video to the end, and hopefully it was informative in some way for you.